Richard Harris. He's Chief Executive at Polshetter Investment Management. Johnson on the show. Richard, good having you. Thanks for joining in. What have you made of both of these moves? Let's first talk about the exemption given by China to some of the U.S. goods. A first sign of attempt to reconciliation, you reckon?
I think so. I think it's a move by China in the right direction. We have to remember that they haven't relaxed tariffs on the main areas of goods, things like American agricultural products. Most of the things have been fairly small and often the kind of things that you might actually want, like specialty chemicals and some drugs. So it's been, shall we say, pretty select. Pretty directive, but at least it's a move in the right direction.
Is it, Richard, it's very difficult to preempt what happens in the next few days or weeks. Would you extrapolate this to more resolution, or would you play safe and not quite preempt any of such moves?
No, I think it's too early for that, and certainly too early for any kind of big move like shaking hands and saying, well, it was all a big mistake. But, you know, obviously it's going to be positive that China is moving in one direction. The problem with these things is that if China moves and Trump says, well, look, I told you they'd move, now they can move some more, it's obviously going to be very difficult for China to make another step. So we can't read too much into it. On the other hand, I think China is probably aware that Trump is going to declare victory, whatever happens, and maybe they just have to rise above it. But I think it's a step in the right direction. I think probably the biggest move, though, in China is the fact that they look as if they're opening up their quotas, they're dropping their quotas to foreign investment, and that, if anything, is probably more important to international investors.
Richard, let's talk about what's expected in terms of whether or not the stance for an aggressive monetary stimulus from the ECB, come today, or for that matter, a 25 basis points rate cut that is expected from the Fed are realistic. I mean, obviously the Fed has been factored in.
Yes, I think 25 has been factored. I think 50 would be difficult. Because it's actually going to be an admission by the Fed that things are worse than they are. So I think 25 is both factored in and is also most likely. On the European side, they also seem to look as if they're going to relax things. But I think we always have to keep in mind the fact that it's not altogether good news. It may be good news for a day for the stock market. It's not altogether good news for interest rates to have to be cut, because that generally means weakness in the economy. So I think that all in all, it's a fairly bitter-sweet move, and we need really to see if they're actually going to do any good, because, of course, interest rates at these very low levels aren't necessarily very stimulative.
10-year Treasury yields finally reached a fresh one-month high, though we've actually seen, the weekly sell-off in the government and corporate bonds subside a bit. What's your take on where you see yields moving from here on?
Well, I think Treasuries obviously were extremely strong last month, and they've now come back a bit, which means that they push yields, interest rates a little bit higher. I see this being maybe more of a reaction to the big rises last month. We've seen a bit of a fall. And don't forget today that Jamie Dimon, who's the boss of JP Morgan, has actually come out and said that the bank is actually preparing for a negative interest rate scenario. So I think we've got to be careful we're not confusing the short term with maybe the more medium to longer term. Medium to longer term, it does look as if investors are still going to want to see bonds as a safe haven.
Richard, just one follow-up. You mentioned that this was arguably the more important move, which is China easing up the quotas. The previous quotas too, thus far, haven't been quite, exhausted. It's a good signaling move. It will not have a material impact, would it?
Well, I think you put your finger on it. Obviously, you have to say, well, China's economy is not doing so well. This is a signal that the economy is not doing so well because they're looking for foreign investment to boost their capital markets. But it is a little bit like pushing on a string. If you're not filling the quotas already, it doesn't really help to extend or even remove the quotas. But the one positive thing is, we won't always be in this situation. One day we will come back to a situation where maybe people do want to invest in China big time again, as we've seen at certain periods in the past, and then not have any quotas would be a good thing. So it's a step in the right direction, maybe not particularly useful at this particular time, but I think it all adds to the feeling that China is thinking very seriously about its relationships with the outside world.
Richard, if this move scrapping the QFII quota does not unleash flood of foreign money into China, where do you see the money flowing within the emerging market basket then?
Well, I'm not sure there's a lot of money flowing around at the moment. I think people are largely sitting on their hands and being quite careful. Obviously, while there is a risk-off scenario, people aren't going to be moving large amounts of money into different markets other than their own. And I think that even though we've had a good few days, that cautiousness is probably not going to leave us for a while. I mean, don't forget that the street is now within, something like 2% of its all-time high. And that's a pretty rare occasion in any situation. And you have to think that, do we have enough positive factors for it to break the all-time high? Probably not. So I think it's going to stay as a resistance for quite a while. So perhaps the next bias is going to be downwards.